Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
Okay, so let's just dive right in. As of the close on February 6th, 2026, TRX gold is trading at $1.59. Now, if you zoom out, that number, it represents a massive 371.8% increase over the trailing 12 months. But honestly, the price is the boring part of the chart right now. The real story, the thing that should make everyone sit up, is the sheer velocity of the volume. Historically, this stock sees what, a daily average of around 6 million shares? Sleepy. But on January 29th, as the price touched a 52-week high of 280, volume spiked to a staggering 63.84 million shares. We're looking at a fundamental re-rating event here.
Or we're looking at a classic liquidity trap, where retail speculators are handing off very heavy bags to latecomers at the absolute top of the cycle.
I'm looking at the exact same data, but I see the hangover, not the party. The stock is already corrected, and significantly from that January 29th high. It dropped over 11% on February 5th alone. Look, when you see 63 million shares trade hands on a vertical chart like that, that is not thoughtful accumulation. That's churn. That is the sound of a door slamming shut. I see why you'd frame it as churn, given the volatility. But I would argue that volatility is the price of admission for a structural shift. The core question we need to answer today isn't about the day-to-day noise. It's whether this is a fleeting hype cycle or a sustainable production inflection, as they call it, driven by gold prices over $4,600. My thesis is that TRX has fundamentally de-risked. It's trading at a deep discount to its net asset value, and that volume spike shows the market is finally waking up to a producer that is self-funding its own growth.
And I come at it from a completely different angle. I see a valuation that is stretched to the breaking point relative to its sales. A company that relies far, far too heavily on a single asset in a complex jurisdiction. And perhaps most damning of all, insiders who are using this exact liquidity spike to cash out. While you see a de-risk producer, I see a price for perfection junior miner where, frankly, the easy money has already been made.
Okay, well, let's get into the substance of that then. You call it priced for perfection, but I call it the successful crossing of the development gap.
That's a buzzword.
It is a specific phase in a mine's life cycle. It is the hardest phase for any junior miner, moving from a speculator with a drill rig to a company that's actually pouring gold bars and generating cash. And TRX has done it. Just look at the Q1 2026 financials they reported on January 15th. This was supposed to be a lower output quarter, seasonal rains, maintenance, yet they delivered record production of 6,597 ounces.
The raw ounce count is fine, but
it is more than fine. It's proof of concept. They achieved adjusted EBITDA margins of 53%. That is the power of operating leverage. But the most critical differentiator here, and the reason I believe the bull case is just getting started, is the self-funding model. Typically, a junior miner, they need to build a plant. So they go to the market, they issue equity, and they dilute the existing shareholders into oblivion. TRX is funding a $30 million expansion through internal cash flow. They improve their working capital to a 1.7 current ratio, about $15 million to the positive, without needing a lifeline.
I'm just not convinced by that line of reasoning because you are ignoring the macro context that allowed for those margins. They realized $3,860 an ounce in Q1 because they're unhedged. Now, that's great when gold is parabolic, but it cuts both ways. But let's look at that valuation disconnect you mentioned. You claim it's cheap. I'm looking at the price to sales ratio. TRX is trading at a PS of 7.95.
Which is high for a generalist stock, I'll grant you, but for a high-growth miner?
It is high for a miner too. Let's compare it to a direct peer, say West African Resources. WAF is trading at 4.66 times sales.
WAF is a much larger entity. You can't really compare them one-to-one.
Exactly. West African Resources have vastly larger revenue, 1.5 billion Australian dollars, and yet the market awards TRX a premium multiple, nearly double that of a more established producer. That tells me the market has priced in a future that just hasn't happened yet. The market is paying for the idea of TRX becoming a major producer, not the reality of it today.
I think the market is paying for the rate of change. WAF is a steady ship, TRX is a speedboat. But before we get too deep into the multiples, I know you want to talk about the selling.
We have to talk about the insider signal. On January 29th, the exact day of that 63 million share volume spike, independent director Norman Betts sold 340,000 shares. He cashed out nearly $570,000. He'd sold another 60,000 just a week before that. He reduced his position by 65.5%. When a director dumps 2/3 of his holding into a rally, he isn't signaling structural shift. He's signaling take the money and run.
That is an interesting point, though I'd frame it differently. Look, insider selling after a 370% run-up is standard portfolio management. If you had a position triple in value, wouldn't you rebalance? And you cannot ignore that the CEO, Stephen Maloney, still holds 2.67 million shares. His interests are massively aligned with shareholders. Plus, the CFO, Michael Leonard, he actually bought 27,000 shares on January 30th, right in the thick of all this volatility.
A token purchase compared to the Betts liquidation.
It's hardly token. A CFO buying on the open market at all-time highs is incredibly rare. It signals he sees the internal numbers for the next quarter and knows they're good. But let's return to the operational reality, because that's where the real value lies. The market is pricing in the sulfide expansion. This is not just digging more holes. It's a technical evolution.
It's a technical risk.
It's an evolution. They are moving from a 3,000-ton per day circuit to a dual circuit architecture. You'll have the sulfide expansion targeting 3,000 plus tons per day, plus a 1,000-ton per day oxide circuit.
Let's just pause and explain that distinction, because it really matters. Oxide ore is the easy stuff. It's near the surface, it's weathered, it's soft, easy to process with cyanide. Sulfide ore is deeper, it's harder rock. The gold is locked inside sulfide minerals like pyrite. It's refractory. You can't just pour chemicals on it and hope for the best. You need serious energy and technology to liberate that gold. The transition from oxide to sulfide is where junior miners often fail.
And that is exactly why the recent updates are so bullish. They are executing on that transition. The 18-meter pre-leach thickener was 95% complete back in November of 25. But the real key here is the Aachen reactor.
Which is what, exactly?
The Aachen reactor is a specialized piece of tech that injects high-purity oxygen into the slurry. It mechanically shears the gas bubbles to make them microscopic, which, massively increases the surface area for the reaction. It effectively unlocks the gold from the pyrite. This unit is already shipping. This piece of infrastructure unlocks the 18-year mine life and the 10.8 million ton measured and indicated resource. This isn't a pipe dream. The hardware is on the ground or on its way.
Hardware is one thing. Getting it to work in the Tanzanian bush is another. I'm sorry, but I just don't buy that this is a seamless transition. You are talking about a company that is 100% dependent on the Buck Reef Gold Project. It's a single asset company. If that Akron reactor gets stuck in customs, or if there's a weather event or a technical failure, the stock goes to zero or pretty close to it. There is no diversification here.
Well, that's true of any single asset junior. That concentration is why the upside is so high.
Yes, but not all of them are trading at 8 times sales. And look at the costs. Cash costs bumped to $1,508 per ounce in Q1. They admit this is due to deeper mining and inflation. As they go deeper into the sulfide body, the rock gets harder. Harder rock means more electricity, more grinding media, more reagents. The costs are only going one way, and that's up. And you have significant infrastructure risk remaining. The completion of TSF3, the tailing storage facility, is absolutely critical. If they can't store the waste, they can't run the plant at these aggressive new targets.
You're focusing on the operational friction, which is fair, but you're missing the valuation floor provided by the assets themselves. Let's look at price to net asset value, or PNAV. This is the metric that matters for long-term holders. It basically asks, what is the value of the gold in the ground versus the price of the stock? TRX trades at 0.39 times PNAV. The industry peer average is roughly 0.68.
PNAV is a theoretical number based on a lot of assumptions that might not hold up.
It's based on the resource.
The market has not credited them for the full 893,000 ounces in measured and indicated resources. Even if you apply a massive discount for the risks you mention, the gap between 0.39 and 0.68, that is the alpha. Compare them to Orezone Gold. ORE is a great growth story, sure, but TRX has a cleaner capital structure, zero debt. That 0.39 multiple is an open invitation for a re-rating as they prove out the sulfide circuit.
That 0.39 multiple might just be an illusion if you look closely at the corporate structure. This was brought up in a very sharp analysis on the value investing subreddit, and it's a point that gets overlooked. We have to talk about minority interests. This is a joint venture with Stamico, the state mining corporation.
It's a standard partnership in Tanzania, 55% TRX, 45% Stamico.
It is standard, yes, but it absolutely affects the bottom line for the retail shareholder. Consolidated net income looks great on the headline, but the allocation of profits to non-controlling interests, the government, means less earnings per share for the actual person holding the stock. When you adjust for that, the profitability narrative gets a lot thinner. And again, I go back to the peer comparison. West African Resources produces significantly more gold, has similar all-in sustaining costs around $1,561 an ounce, but trades at a cheaper revenue multiple. Why would you pay more for TRX's complex single asset structure?
Because of the flows. We are in the middle of a great gold rotation. Capital is moving from the large caps like Newmont and Barrick, which are slow, low-beta movers, down to the high-beta juniors. And the smart money is positioning for this. Look at the institutional filings. Citadel Advisors increased their position by 50% recently. They now hold over 442,000 shares. Hillsdale Investment Management entered with a brand new position of nearly 744,000 shares.
Institutional ownership is still a drop in the bucket.
It's growing, though.
It's roughly 2.3% of the float. That's negligible. This stock is dominated by retail sentiment. I've looked at the stock to its volume and the Reddit threads on our penny stocks. The volume spike on January 29th wasn't Citadel carefully accumulating. It was a stampede of retail traders chasing momentum. That makes the stock incredibly fragile. When the retail crowd gets bored or scared, there is no institutional floor there to catch the price.
I disagree. The entry of quant funds like Citadel suggests they see the mathematical arbitrage in that PNAV gap I mentioned. They aren't chasing Reddit threads, they're chasing the disconnect between the share price and the gold price. And regarding the retail sentiment, the consensus ratings are strong buy with price targets ranging up to $1.53.
Wait, hold on. We are trading at $1.59. The stock is already trading above the analyst price targets. When the price exceeds the strong buy target, that's usually a sign that the equity is overextended. The analyst predicted a move to $1.50, and the market squeezed it to $2.80. That's just irrational exuberance.
Or the analysts are behind the curve on the spot price of gold. Most of those targets were likely modeled when gold was at $3,500 or $4,000. We're now looking at spot prices that are breaching $5,000. The analysts will have to revise upward, and that will be the next catalyst.
If the regulatory environment doesn't strangle them first.
I was waiting for you to bring up Tanzania. I view the regulatory backdrop as a moat, not a risk. The government is cracking down on land banking. They are reclaiming licenses from companies that just sit on land. This favors active producers, like TRX. Their partnership with Stamico makes Buckreef a national asset. The government needs this mine to work to meet their own revenue targets. They are incentivized to help TRX succeed.
That is the optimistic view. The realistic view involves the new mining local content regulations introduced in late 2025. These are stringent. They now require joint ventures to be with 100% Tanzanian-owned indigenous companies.
TRX is already compliant through Stamico.
It's not just the ownership, it's the supply chain. The new laws demand that 20 categories of goods must be sourced locally. We're talking about critical mining supplies. This introduces massive supply chain complexity. If they can't source a specific part for that 18-meter thickener because it has to come from a Tanzanian-owned entity that doesn't exist or doesn't have stock, the self-funded timeline just blows out. Delays cost money, and when you are funding from cash flow, you cannot afford delays.
It's a challenge, certainly. But companies adapt. And frankly, the African Renaissance narrative we see trending on X suggests that capital is flooding into these jurisdictions precisely because they are resource-rich. Geopolitical instability elsewhere makes Tanzania look comparatively stable.
Stable, perhaps, but expensive. And with cash costs already creeping up, any additional regulatory friction on the supply chain is going to eat right into those margins that you're so excited about.
Let's pull this together. We have a stock that's run 370%. It's pulled back from the highs. The question for the listener is what comes next? I see TRX as a rare anomaly. It is a junior producer with actual cash flow, zero debt, and a planned expansion that is physically happening right now during a historic gold bull market. The current price consolidation around 159 is a healthy pause. The market is waiting to see the sulfide expansion, Track 2, come online. When it does and they unlock that 18-year mine life, the P/NAV gap between 0.39 and 0.68 will close. That is the opportunity.
And here's my closing warning. Easy money has been made. You don't buy a 370% run-up without expecting serious volatility. TRX is an unhedged player. That means it is a leveraged play on gold staying above $4,500. If the macro environment shifts, if gold pulls back even 10%, the internal funding model collapses because their margins compress. Combine that with the fact that insiders like Norman Betts are taking significant profits, and that the valuation on a price-to-sales basis is nearly double that of superior peers like West African Resources, I think caution is the only rational stance. The operational wins are real, but the price you are paying for them today is just too high.
We will find out soon enough. The next quarterly report will confirm the progress on the sulfide circuit. That'll be the deciding factor on whether this valuation holds or moves higher.
Indeed, it always comes down to the rock and the execution.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.